Generally in tax law, there are two things that will happen that are deemed to be beyond your control. One is death and the other is divorce. Now, you could argue divorce has an element of control about it, but the tax department doesn't want you staying together in a relationship just because there's adverse tax consequences to it. But I would just like to focus on death for a moment. The one true thing inevitably we will occur, but we don't really want to get there. So part of looking at your estate planning is to look at how to mitigate some of those risks. For companies, one of the biggest issues usually is loss carry forward, losses, and the other one is what we call imputation credits, which I'll just use as a very simple abbreviation of ICA, imputation credit accounts. Now, generally when you transfer shares between person A and person B, this triggers a disposal. And if more than 51% of the shares are transferred, losses can disappear in the company. If more than 34% of shares are transferred, generally the imputation credits will then be lost. These are important for dividends when you go to pay them out, and it recognises the tax the company's already paid. And we certainly don't want the Minister of Finance to get more than their fair share. So the question that comes on death is, how do you protect both the losses and the imputation credits? Well, interesting enough, there is a lot of look-through provisions. What the look-through provisions basically say is, let's introduce you to Bob. Bob owns 90% of the company. Unfortunately, Bob has an early demise, and in terms of his will, he then leaves his shares to his sister, Jane. Bob dies on the 15th of September. Terrible day, tragedy occurs, everyone cries. Under Bob's will, he transfers his shares to Jane. He bought these shares on the 1st of April 2020. So he hasn't had them that long. What happens now is that when Bob passes the shares to Jane, under the purposes of his will, Jane is deemed to have acquired them on the 1st of April. She steps in to Bob's shoes. Now in this scenario that might seem relatively academic, but if Bob bought these in 1980 and has held them for a long period of time before he passes, Jane is still treated as having purchased them on the 1st of April 1980. So the point behind that one is the continuity carries on as if Jane was Bob on death. It's one of the more generous look-through provisions we have in terms of the provisions within death. But the question that then comes is, Jane says, well, actually, you know what? I don't really want to hold these shares in my name. I am going to transfer them through to my family trust. This now triggers a change. While Jane is stepping into Bob's shoes, when Jane sells to her family trust, it triggers a disposal of the shares, impacting on the imputation and losses carried forward. So the importance here is when you're considering your assets as part of your general succession planning is to ensure your will has the correct entity getting any shares you may hold in your individual name. Otherwise, there can be some effective tax planning once you have gone. And the last thing you want to be done is cursed on your grave.